Hello everyone, thank you for watching this video. In this video, I would like to share the topic on return on capital, which is one of my favorite financial ratios. So what is return on capital or return on capital employed? This ratio, return on capital, it measures how well a company is generating a profit by investing its capital in the business. So we prefer to have this ratio to be at higher percentage, preferably more than 20%, because it means it's easier for the company to grow and generate profit without much capital. This ratio, return on capital, is unlike ROE, return on equity, because ROE, right, it analyze the profitability based on the equity only, whereas return on capital, it takes the whole balance sheet, the whole capital structure into account for the profitability analysis. So there are many ways to calculate return on capital. My preferred way is to calculate the ROC based on the operating side, which is given by this equation. The operating profits divided by current asset minus current liability plus the plant property equipment. This ratio is much cleaner because it excludes goodwill into account. It measures the true profitability based on the operating asset. The other way to calculate the return on capital is here based on the capital side. It's given by this equation: operating profits divided by the sum of equity and debt. So why return on capital is important? So this is my favorite guru, Charlie Munger, said this before. Over the long term, it's hard for the stocks to earn a much better return if the business cannot command a higher return on capital. For example, if the business only earns 6% return on capital over 40 years, and you buy into that company and you hold it for 40 years, you're not going to make a very much different return than the 6% business return on capital, even if you bought it at much lower price or much a huge discount in the first place. Conversely, if the business can generate a high return on capital, for example 80%, over 20 to 30 years, even if you paid a much higher price, much higher P, you are going to end up with a very good result because the business itself can grow much faster without much capital. Can grow the profits much faster. That's why the share price can outperform. So here is a case study. What you can do, how you can get this return on capital, right? You can go to Google, you search the company name, space, Morningstar. So usually the first in the result, the list, right, will lead you to the Morningstar web page. What you need to do is go to the tab, the operating performance tab, and you go to the line here, the return on invested capital, and you study their numbers. Look at these numbers, whether is it more than 20%. So as you can see here, Sheng Siong itself is over the past 5 or 10 years can command above 20% return on capital, which is wonderful. So next, what you can do is you can combine the return on capital and the free cash flow margin together into the matrix. So here I have the horizontal. My matrix works like this. Horizontal axis shows the free cash flow margin. The vertical axis shows the return on capital. So we like to invest in the company with high free cash flow margin and the high return on capital, which is given in the top right corner here. Because high return on capital is show the company management is a good capital allocator, or it can generate high profit with very little capital. It also shows the company is a cash machine, it's a cash cow because it can give you very high free cash flow margin. Why the company can achieve this? How the company can achieve this? Because it has some competitive advantage. So I will say company in this quadrant are high quality business. On the other side, the company has a low return on capital, very low free cash flow margin are those with poor capital allocator or allocation. So usually are those management. Why the company has a low capital allocator usually are because the management itself are not competent, or the industry itself is very competitive, or it's not easy to generate profit. So I would say the investment in this quarter are those are very poor quality one. Okay, it's very hard for them to generate high return over the long term. Okay, next I select a few Singapore companies, Singapore listed companies here. I put in the profitability metrics. So on the horizontal axis here, I have a 5-year average free cash flow margin. On the vertical axis, I have a 5-year average return on capital. So Sheng Siong Micromechanics and Credit Bureau Asia, they are those I can say they are high quality because they have high return on capital and high free cash flow margin. On the other side, you have a ComfortDelGro, Singtel, Genting. They have very low return on capital. This is the 5-year average. Very low return on capital and low free cash flow margin. I would say these are the poor quality business, or maybe their business it can be why the company can achieve low return because it could be the business itself were disrupted, or they are operate in a very high competitive environment. So I tend to avoid investing in this quadrant, as if I said just now. Okay, so here is to show you the correlation between the return on capital and the PE ratio. So company with high return on capital and high earnings growth can command a higher PE ratio. So this is a research done by these two gentlemen. So I put it here for you guys. So as you can see here, usually company with higher return on capital tend to have a higher PE ratio as compared to those with lower ROC. And also the company with higher earnings, right, tends to have higher PE ratio. So this is because it can grow the earnings much faster. Okay, return on capital is one of my big 5 financial ratios. So this is my big 5 financial ratio as a long-term investor. So I always look at these 5 financial ratios. Whenever I look at the business itself, I look at the gross margin because it tells me the profitability of the product. I look at the free cash flow margin because it tells me the cash profitability of the business. I also look at the quality of earnings. I look at the return on capital. I look at the net debt because net debt to equity, it measures the financial strength. Negative net debt, it means the company have more cash than debt. So I prefer to have negative net debt business as my investment. So with that, I will end my presentation.